Today, I'm very pleased to be joined by Martin Grosskopf, VP and PM, Director of Sustainable Investing at AGF Investments. We're here to talk about ESG investing. Martin, your journey through into capital markets, and while this topic has been all over the news in the last year or so, this is in fact a very old and dare I say original mission for you and the team at AGF. For reference, they also recently launched their sustainable ETF on NEO, AGSG. Martin, thank you very much for joining us today.
Thanks, Eric. Great to be here today.
Pleasure. And what really impressed me a lot when we were setting up for our discussions today and some of the pre-calls, is a bit, in fact, your history in the space, both you personally and AGF as an organization. That's maybe a good place to start. Maybe you can give us a bit of a primer on your background, capabilities, and how you landed yourself at AGF.
Well, it was quite a circuitous journey, I guess. So, ending up in this industry and focused on sustainability and financial markets. But my background was more from an environmental specialist. That's my technical background, and I worked in an engineering firm in Canada, international focus, but Canadian based, and dealt with environmental impact assessment, mitigation, social impact, management of these issues within companies, and attempting to make projects really have less of a negative impact on the environment. And along that journey, I thought, wouldn't it be nice to direct capital more effectively in the first place, and went and got an MBA and a bit of a financial background, but joined the industry back in 2000. And at the time, this strategy, at least precursors to this strategy that I manage today, it was really one of the first globally that focused on sustainability as an investment lens. And I thought, this is interesting, right? And let's see where we can go with this. So fast forward 21 years, and here we are today.
I like it. And it shows, obviously in your approach as well, you've got a history and knowledge about the space, obviously, that I think is very unique to your current situation. Now let's talk a bit about AGF. The fund itself is actually not a new one, despite it being new in the ETF vehicle. It's actually been around for quite some time. Can you give us a bit of a primer on the fund mandate itself?
Yeah, sure. I mean, the original thinking for this strategy actually goes back to the early 90s. There was a report from the UN called the Brundtland Commission Report, which actually coined the term sustainable development. And so the thesis of the strategy was that, look, if these issues are important, they may be actually important enough to direct an investment strategy around. And so that more or less became the lens with which we look at capital flows and investment opportunities in the financial markets. We define an opportunity set of themes around sustainability, the basic building blocks around water, waste, energy, and health. And then we go and define a bunch of sub-themes and value chains that we can truly invest in the public markets. And so that strategy has really, it's honed its approach. It's morphed over time as the opportunities changed, but more or less the premise has been the same over this long period.
It's actually incredible because you've clearly been at it longer than it's been a headline on that front, and
at least a positive headline.
Absolutely. Well, it actually begs maybe a bit the question as well. That there's often, and I know we saw it last year and certainly in years previous where it maybe wasn't as much of a mainstream topic. But there's always this talk about compromise with ESG investing, and you're always kind of thinking differently, or maybe there's a chance you miss a risk or reward payoff. Can you talk to us a bit about how you're constructing the fund, the thesis that you're putting together, and really what your lens is, and why you don't think that is in fact a shortcoming for you and the AGF team?
Yeah, I think that, as I mentioned right from the start, I mean, if you view sustainability as an opportunity set, and if you think that the velocity of those opportunities are accelerating, then you can devise a strategy that is very differentiated, provides great diversification for investors, and yet that can perform at least in line with a large global benchmark. So most of our clients, will use a conventional benchmark like MSCI World to gauge our performance. They want a sustainability strategy to outperform conventional global equity strategies over time. That's really what we're trying to do. It's easy to produce a portfolio that's different. The challenge is, if you adjust for risk, are you providing a return stream that's compelling for investors? So the big changes over the years actually had to do with baking that cake more effectively, because years ago, prior to the great financial crisis, there was just a lot of fairly volatile, smaller cap companies that focused on sustainability. It was a few water pure plays. If you remember, in Canada, we had companies like Xenon and Trojan that were now assumed by larger entities in the industrial markets. We had some solar companies, but the technology, the regulatory pressure, the consumer interest was just not where it is today. Today, themes around energy transition, themes around circular economy, themes around sustainable ag, these are driving capital deployment in so many sectors of the global economy. So it's not a sideshow. It's not a niche where it was maybe 25 years ago. Now it's actually, a mainstream investment opportunity that I think people can take advantage of.
I'd agree with you, and it seems to have permeated beyond, I'd say an inside baseball kind of realm discussion. It's moved out to retail investors. You're starting to see the interest in voting with your hard-earned dollars into the companies you're investing in starting to show up on the discussion table as well. Maybe perhaps begs the question, we've been talking about credibility, we've been talking about performance and how you're going through that. It maybe, bears a look, especially in this current market environment. How has the fund performed? Give us a bit of a rundown on what you saw through last year and what you're seeing now.
Yeah, so I think, COVID was an accelerant for areas of sustainability. I mean, I always go back, to the environmental science of this all, and pandemics not unpredictable. They have been fairly consistent, in terms of emerging every few years. So that it would happen wasn't actually the surprise. It was really just how quickly it spread and how fatal it was in terms of its impact on human health. But that is an interaction between the environment and humans, right? It's reflective of often issues of poverty, issues of poor environmental management, and then those diseases can spring from animals to humans. So, I digress there, but the point being, you can't hide from these issues in the financial markets. I mean, we're probably 20 trillion in terms of fiscal and monetary stimulus to deal with one pandemic. I mean, think about that, right? So would it not be nice to be able to direct capital more effectively, even spend a few billion on pandemic reduction in emerging markets, right? That's not happening. But I think what we are seeing is investors wake up to the fact that these are long-tailed issues, and in some cases there are opportunities, right? If you think of climate change, again, a big systemic issue. And now countries and regions will compete in terms of which of the countries are going to be able to accelerate their economies towards lower emissions. That means capital flows. That means investment opportunities arise. So last year, the markets kind of woke up. So I've been in it for a while. You're kind of in the woods for a long period of time, and then you never know when the market wakes up. Well, the market woke up last year, right? So we've had a lot of green enterprises attracting capital. And in some cases, maybe there's a bit of froth there. That's to be determined. But there's no doubt the interest is there. And I think now the fear of missing out is there, which is important,
It has certainly been recognized, which I think is maybe the part that was missing a few years ago. I distinctly remember, being at a few ETF conferences, even where you'd have a single session or a small presentation on ESG, and you move straight back to your traditional core asset classes and diversification strategy discussions. But there are now both visibility and awareness campaigns, full-on events dedicated to responsible investing, and they continue to grow in popularity over the years as well. So it's great to see it finally getting recognition, admittedly under some unfortunate circumstances, but it's where there's opportunity, I suppose. Curious question for you. It is a fund. You're holding a lot of different companies, clearly in the portfolio, all of them public, likely across the globe. Can you talk to us a bit about a few of the bright spots in the portfolio and how they've responded? Maybe conversely, things that maybe didn't go quite as planned over the course of the year.
Yeah, so I think, COVID did provide that shock to your strategy. It demonstrated where you were well positioned and where you weren't. And if, you had chess pieces on the chessboard that didn't act properly, it was a decent time to reposition, right? So there were a few names where, even though we were positioned late cycle, I guess, going into COVID, we made adjustments. Towards the end of the year, we have been trimming a few names that we thought have got a bit ahead of itself. But we're sort of in a post-recessionary playbook, right? We're dealing with massive stimulus. We're going to come out of a recession, dramatic recession. And so we've been adding to areas of the portfolio where we think we can find cyclical growth. So for us, that means, for instance, recovery in automobiles, right? But not conventional, more towards EVs. So the big spend obviously going towards low emission vehicles. That for us is obviously an area where we have a decent exposure around the globe. It's not just, the headline names maybe in the US, but also in Japan has a huge opportunity there, Europe. And then we also have been taking up exposure to areas that really have not done well for 4 or 5 years. If you think about the agricultural cycle, farmer income's been very poor, right? And the trade dynamics have been very negative for farmers. That's changing. The Biden administration will have a better relationship with China. It's improving crop prices. Crop prices means better income. Better income means more spending on things like irrigation equipment. So we've taken up our weight in a sub-theme called irrigation. Water use is going to become critical on farms as climate change accelerates. And so this is an opportunity for us to get better exposure to some of those themes.
Interesting. You just see how you kind of slice up the ecosystem based on what is ultimately a long-term view and the various opportunities to build into those kind of projections, I suppose, is a bit the function. Makes perfect sense, but obviously not all investors think that way up front, and probably why discussions like these happen all day long for you. What's something that's unconventional in the portfolio today? What's kind of your, say far out, way off in the future idea that you think people haven't really thought about or recognized yet, but you guys are positioning for?
Yeah, there's certain areas that are, I would say early days still. I mean, we look back at it. We were involved in plant-based protein 15 years ago. That was too early, right? So you got to be careful. I mean, plant-based protein as a source of growth now in the food industry is huge, right? And Beyond Meat kind of cracked that. So there's elements in the food industry that we find interesting that are emerging. If you think of, for instance, we own a company that does enzyme technology, fermentation, and it's all around sort of the use of probiotics, but probiotics for human health, but also for animal health. That's in its early days, taking antibiotics out of the farming industry and replacing it with more natural processes to improve resistance to diseases, right? So I think that's an area that is perhaps under-recognized that we see having huge potential going forward. And of course, we're always tracking areas that we think will be critical. I mean, in the vehicle infrastructure around battery chemistry, we have positions in some areas that are not yet, fully adopted, like silicon carbide technology, but where the company is going to be the leader in that technology as it's adopted for fast charging, as an example. So these are things that we were willing to take early positions on.
Well, that is actually a very cool concept. Confess, this is actually the first time I'm hearing about it as well. So, and obviously knowing there's many other folks researching the hell out of this business to figure out where that next opportunity and stage is. To our audience, I guess you heard maybe something else for the first time as well today, but maybe tied to that, looking at the timing of the AGSG launch in ETF format. It's been around in a mutual fund form, I understand, for almost a decade. What kind of, shifting gears a little bit, what made you think about bringing it out in an ETF form? I assume folks were poking around and asking how they could buy it, but I'm curious to hear your thoughts there.
Well, I'm in a bit of a privileged position as a portfolio manager because, I'm fairly agnostic to the vehicle. I mean, the ETF vehicle is kind of, a great vehicle for the democratization, of investments. And so it's accessible to everybody. And I think that's important, especially for this type of strategy. So, as a PM, I want to be relatively ambivalent. In some cases, people want to own a fund, under a mutual fund structure. We have pension clients, institutional clients that want to own their own account, a seg account. In this case, the average investor can access an ETF and have that liquidity. So I think it's just an evolution of what we're trying to accomplish. Right?
Makes perfect sense. Give them choice. The ETF can be the Swiss Army knife of the investment world, and you've got investors of all sorts you want to reach. At the end of it, it's one way to do so. I'm a bit curious. You've been out on the street now with the ETF at the very least since October, and obviously with the mutual fund for quite some time before that. What are some of the things that your advisors, your current clients are asking you about, especially as we roll into a new year? We're January now. How are folks starting to think about positioning themselves for the year ahead, and where do you see your mandate in particular kind of fitting into the broader advisor portfolio?
I think we're getting in to see advisors that, in the past were perhaps a bit more skeptical about sustainability or ESG generally. I mean, I like to differentiate what we do from just a ESG overlay. That's often used just as a risk process step within a conventional fund. I mean, we are investing in companies that we think every one of those companies has a building block for sustainability. So, that thematic mentality and the opportunity of investing from a sustainability standpoint is something that, many more, I think, advisors and individuals are waking up to as something that could be, at least a portion of their overall portfolio. And we provide, I think, a compelling way to get that exposure. It's difficult. I mean, certainly, if you're just playing passively in this space, it's, the challenges are that, not every company is going to be succeeding, and I think picking through those will also help with downside protection, which we're very focused on, because we do have also institutional clients whose strategies are modeled on the same strategy that's offered as an ETF. So we've got to be good risk managers, and I think advisors are aware of that we're doing that.
That makes sense. Everybody expects these things to go up all the time, but obviously not always possible. You raised an interesting question with this screening and filtering and kind of looking at the portfolios themselves. But out of curiosity on the portfolio itself, do you have, or I suppose maybe the question is, how are you going about finding all of this data and information that is constructing that portfolio today? Is it all you and the team? Who else is partnering with you to kind of bring all this information to the forefront so you guys can make your decisions?
Well, first and foremost, we want to have our own expertise. So whether it's my background or the individuals who work on my team, they all bring some element of sustainability, environmental knowledge, ESG knowledge to the table. And so we've got a strong internal team that can analyze that data and dialogue with companies around the data that we need. We also supplement that with external resources. So we've been working with vendors in this space, honestly, for over 20 years. We know all the tools that are available, and we partner with at least a couple of the leading shops that provide data that, in some cases, let's face it, it's not yet a regulatory requirement, so we've been working with firms that are able to do modeling of, if you're buying an electric car, it's great, it's got a big advantage from an emission standpoint, but what are the inputs to making that car? Water use, emissions, what are the implications? And we actually try to develop models that can estimate that use. And so we need some external help, there's no doubt, but always with the critical eye of the internal expertise.
That's actually encouraging and also incredible to hear when you think about the monumental pile of information you've got in front of you, of course, to look through. Is there, I'm thinking about it as well, the fact that you're looking through into the underlying kind of construction of these things, that also opens up a whole other world. I'm sure there are other companies that supply that aren't public, that don't report. I presume you've got to reach out and learn more and try and ask questions from people in person as well to try and discover some of these things that may not be showing up in reports.
Yeah, there's no doubt. I mean, data in sustainability in some ways in its early days, I mean, it's kind of 20 years in or more, but still relative to financial data, early days. And then relative to what's required from a regulatory standpoint, it's still pretty early. So, there are minefields out there. There's also an incredible amount of data. To your point, wading through that data is something that's important. Disclosure is critical, but you need to get to the kernels of stuff that make a difference, from your investment perspective. And you'll be bombarded with reports that provide all sorts of different metrics that maybe have nothing to do with whether you're going to have a good investment.
Fair enough. Yeah, there's a lot of red herrings, I suppose, in that journey that could say, oh, this could be really interesting, and it turns out to be exactly the opposite.
Mm-hmm.
Interesting. Humor, I mean, you've been out chatting with clients. What's one thing that an advisor has been asking you about, would you say is either a misconception or perhaps a misunderstanding, whether it's about your fund in particular or about ETFs or ESG in general? What's still that one common thing that keeps coming up over the course of discussions that if you can get it right on the record once, we do here?
Well, I think that there's a misconception that there should be and complete fulsome agreement on what a good company is. We know that there's no agreement from a financial perspective. Every financial analyst has a slightly different view on how to value a company, and that makes a market, and yet there's an expectation with sustainability or with ESG data that, you can get a rating and another rating company will agree with it, and the third rating company will agree with it, and we all agree that it's a great company, right? Well, chances are that's not going to be the case, right? You're going to have difference of opinion, and that opinion is important, and that's what makes a market. So I think there's still a naivety that that there will be a rating, and if we all just use that rating on the company, we'll have better returns. In fact, I think it may go the opposite. When there's fulsome agreement on a company being great, watch out, right?
I think the same may also apply to markets in general. To your point as well, it is a market first and foremost, I suppose, and the information and thesis and decision you make behind that second. But very interesting. I'm a bit curious to learn, as well, like some of the future thoughts, maybe not necessarily directly tied to the mandate itself, but you've clearly got an entire career, personal interest, motivation, and drive attached to sustainability. What are you looking at? Maybe it's a personal question. What are you looking at that's 5-10 years out from now that you see maybe one day becoming the now ESG mainstream element? What do you see as that next step in your both professional career? Maybe talk about the fund as well.
Yeah, I think the biggest change that's happened in the last year was obviously the amount of stimulus and the way the world woke up to a risk like the pandemic. When I flash back to the great financial crisis, there wasn't as much directed stimulus. There was stimulus that was designed to keep the economy going, which we have as well today. But today we also have elements that are essentially providing direction to the economy. If you think of Biden's agenda around $2 trillion in green spending, if you think of the EU Green Deal in terms of defining how capital will flow to businesses that are more sustainable over time in the EU, Japan and Canada have made commitments for net neutral by 2050 and China by 2060. So that dynamic wasn't there, in the last crisis. And I think what's exciting for me is to see how that plays out. I mean, commitments are one thing. Obviously, performance is another. We want to see regions perform well on sustainability metrics. We want to see companies perform well. But the excitement for me is to see this play out, because now we've set the direction, and that's being supported by not only stimulus, but increasing regulation and also corporate interest, right? The Business Council in the US moving from Milton Friedman's dogma of, shareholder primacy and adopting a stakeholder model. That's a big deal, and to me, that's exciting, because we're saying that communities matter. We're saying actually governments matter. And we're saying that the corporations can play part of the solution, not the whole solution, but part of the solution. So for me, that's why I got into the industry in the first place, and I think it's only beginning to play out, right? So we've got a nice road ahead of us.
But it is more so a movement, an undercurrent, something that has finally come into place that has made, the surface level that I'd say most investors see in a headline or a newspaper clipping these days actually become enabled. People have recognized that the companies, governments, industries are starting to see it as a critical component. It must be both rewarding and encouraging to finally see some parts of the world converge on the way you've been thinking clearly for a very long time.
Yeah, and it's also, the challenge is to gauge where the enthusiasm gets a little ahead of itself. That's what you're always looking at as a manager. Once everybody seems to be speaking the same language, you start to get worried.
A bit of an echo chamber effect, and now what else do I need to be looking at in order to stay ahead of all of this? Very interesting. Maybe tell us a little something that we don't know and can't read in the headlines, whether it's you or the fund itself. Give us something that we maybe haven't covered off and talked about today that you'd want our user base and audience to know about.
Yeah, I think, in terms of other areas that we're looking at, it usually has to do with, trying to find that confluence of increasing government interest, consumer interest, and technology. So it's sort of, you need those three factors to really make an exciting sub-theme for us and to start to build out the value chain that we can invest in the public markets. So I think that dynamic often begins in venture capital in the private markets. We track a lot of stuff that's going on there, where there's individuals or foundations that are willing to fund things with very long tail. And we're trying to gauge when that becomes something we can invest in the public markets. So, you think of an area like biomaterials, like how do you take the petrochem molecules out of, plastics and replace it with something, that's bio. These are areas where, we're super excited about what's happening. Not yet great investment opportunities in the public markets, but the way things are going and how quickly things are changing, like it did with plant-based, you never know how it may be an opportunity within the next 2 or 3 years, right?
Well, that is actually a fascinating comment. And one question actually I wanted to ask, I'm glad you tabled it, because ultimately, companies can show up tomorrow as public organizations and then all of a sudden become eligible. But knowing that you're looking ahead of that, obviously that's what you and the team are probably spending a good chunk of time on, because the data there, I'm sure, isn't as good as the public company disclosure, never mind all the things I'm sure you're after. But keeping an eye on those things early, no doubt an important part of thinking differently from a PM perspective, most definitely. And that's encouraging to hear as well, and something that I think our audience certainly should appreciate as far as the time and energy it takes to construct these mandates as they go public. The effective masterclass he's provided us with on ESG investing and some of the history and thought that went into both kind of curating Martin's pathway to AGF and also to the mandate that he's running in its current both mutual fund and ETF form. Martin, maybe last remarks out to you, and to kind of wrap up today's presentation, that last sound nugget for an investor, an advisor, what would you leave them with?
Yeah, I think just the notion that sustainability as an investment opportunity is real. That, as I mentioned, it's not a niche any longer as it was decades ago. There's real capital flows that are changing, especially to meet some of these long-tailed objectives that we have as societies now. And I think investors are increasingly interested in being involved in that transition. So I think that's maybe, certainly something that individuals and advisors want to keep top of mind.
Sage advice to our audience. Thank you for joining us today for one of our first NEO spotlights of the year. Martin, thank you very much for joining us today. We're grateful for your time. I appreciate you taking our questions, and grateful for the opportunity to chat and catch up. Hopefully we'll be able to do this in person at a NEO lobby sometime sooner rather than later. To our audience, if you've got questions, you've likely got an AGF national accounts or a wholesaler nearby. Reach out, ask questions. You've no doubt checked out Martin's profile on LinkedIn now that he's told you he's got an entire career in this space just to prove it. We're, of course, here at NEO as well. If you have any questions, we can help point your way to the appropriate folks at AGF. So thank you all for joining us. Please enjoy the balance of your afternoons. Do your part to stay safe. Martin, thank you.
Thank you. Appreciate it.